So let's discuss a little bit about how financial distress affects firm value. So with an all equity financing company, in our previous example, Armin's assets are worth 150 million if it succeeds, 80 million if it fails. So the impact of financial distress with debt of 100 million, Armin is going to be forced into bankruptcy if the new product fails, right? The value goes below the value of the debt. So some of the assets are going to be lost to bankruptcy. So debt holders will receive less than $80 million. If you assume that debt holders receive only 60 million, right? Because they're going to get less than the 80 million, right? That accounts for the financial distress costs. So now we have, without leverage, it's either 150 or 80. With leverage, it's 150 or 60. So now we have a difference in the value to all investors, all right? And in this case, primarily, the loss goes to the failure goes to the creditors. So again, the difference of $20 million is due to financial distress costs, right? These costs are going to lower the total value of the firm. And so in this case, what we're saying is because the total value goes down, the proposition one, if again, remember, let's think about what proposition one means. Basically, it says that it doesn't matter how the company finances, the total value of the company between all investors, creditors, and shareholders will be the same. But in this case, with financial distress, that is no longer true. There is an additional cost due to this financial distress. So equity holders obviously lose their investment in the firm, and they're not going to care about bankruptcy costs because they lose their value. It doesn't matter, right? However, debt holders recognize that if this new product fails and the firm defaults, they're not going to be able to get full value. So as a result, right? I mean, they know this ahead of time, right? It's part of the thought process, right? They're not going to be willing to pay the same price or give the same amount of money to the corporation. Well, they'll give ultimately they'll get the same amount of money, but they're going to pay less for it. So if you kind of think of this, if just give an extreme example, if they were going to pay $1,000 and we needed 100 million, then they would have to sell 100,000 shares or 100,000 bonds to get the 100 million. But if they know that there's this problem, and again, just so I can make the math easy, maybe the value of the bond falls to $500. So now to get the 100 million, they have to double the amount of bonds that they issue to get there. Again, the creditors are going to not want to pay as much. Again, it's kind of a risk thing, right? In order for them to get paid, right, to get a higher rate of return because of a higher level of risk, they're not willing to pay as much when they issue or when they buy these shares. Now, if the debt holders pay less, that means there's less money available for the company to pay dividends or to repurchase shares or to make investments. So in the end, when securities are fairly priced, the original shareholders of a firm pay the present value of the costs associated with bankruptcy and financial distress, right? Somebody has to make up the difference. That cash has to come from somewhere, and that cost ultimately comes from the owners of the company. So we end up with what we refer to as the trade-off theory. So the total value of the firm is the value of the unlevered company plus the present value of our interest tax shield minus the present value of financial distress costs. And how I like to kind of explain this is think this number, if you remember, if we did this, it was T sub C times D. So every dollar that you borrow, you get a benefit, TC, whatever that happens to be, whatever that tax shield value is. But the present value of financial distress, this number changes. The more debt you have, the bigger this number gets. This number is steady. This number increases, right? So if you kind of think about this, right, we had this graph, right? Here was V sub L equals V sub U. Here was the one with the tax shield. So what this is just saying that as the company borrows more and more money, eventually this piece becomes bigger than this piece. And at that point, there is now a decline in value. And if it grows big enough, the total value of the company will now also start to decline. So again, there's three key factors to figuring out the present value of these distress costs. Number one is the probability of financial distress. The more liability you have, the more the probability is, right? It also increases with any volatility of cash flows and asset values. So probability of financial distress is also going to, it's not for certain, right? It changes. The magnitude of the costs after a firm is in distress, right? Some industries incur much higher financial distress than others. There are two examples here is technology and real estate. Technology has extremely high financial distress costs because most of their assets are intangible, right? They're human capital, right? Trademarks, things like that that you can't sell very easily, if at all. A real estate, though, firm has relatively low costs because a majority of their assets can be sold, right? It's more of a tangible company. So the magnitude of costs are dependent on the kind of industry that you're in. And finally, what is the appropriate discount rate for these distress costs, right? Again, they're high if the firm does poorly. So again, the higher the beta of the company, the lower the beta of the financial distress is going to be. So the financial distress from the beta of the distress costs are opposite to that of the fund. So essentially, beta is negative. And the higher the company's beta, the more negative the beta of its distress costs will be. So, of course, then the present value of the distress costs are going to be higher for companies that have higher betas. But that also makes sense with part two that talked about volatility. The more volatile the company, right, the higher the beta is going to be. So let's think about what an optimal amount of leverage might be, right? So for very low levels of debt, the default risk is really low. So the main effect of the increase in leverage is just the increase in value because of the interest tax shield. But as debt increases, probability of default increases, and of course this financial distress cost increases, reducing the value of the firm, as I mentioned just a couple of minutes ago. So the trade-off theory says the firm should increase their leverage until it reaches this maximum level where we have maximum firm value. At that point, tax savings would be exactly equal to the increased probability of costs of financial distress. So we have more questions, right? Sometimes we open more questions than we answer when we go through some of these theories. Why do companies choose debt levels that are too low to fully get the benefit of the interest tax shield, right? Differences in the use of leverage across industries, right? I mean, what are the answers to those questions? And we don't have those answers. We don't know why do companies act in this way? Now, there's some other theories. There's some concepts we can talk about, and we will talk about. But in general, this doesn't answer all the questions. Ultimately, we get a picture of it. Really doesn't matter what your distress costs are. The graph of value is this curvilinear function. It's not the V sub u equals, it's not that horizontal line, right? It's not this line, right? It's not this line. This is V sub L equals V sub u plus T times D, right? This is just V sub L equals V sub u. It's in between those two, right? But there is a maximum point, right? So the implication of this is that there is an optimal level of debt. We just don't know what it is. Why don't we know what this amount exactly is? Why can't we calculate that? Well, we need to know something about distress costs, and a lot of them are indirect. A lot of them are very difficult to measure. The other aspect of this is this value of the firm is the market value of the firm. And of course, in the cost of capital structure, where we're looking at proportions, we're looking at the market value proportions. And of course, the market values change all the time. So even though we have this curvilinear function, it's only at this point for an instant in time. And then the values change. And then we have changes in distress costs. So we're going to continue. We still have a few more videos to discuss financial distress and how it affects management's decisions. We can say that there is an optimal amount of leverage. What most companies strive for is a target structure. And it is a structure. I'm sure you've heard many companies say, we like to keep our debt between 40 to 60%, right? Oops, I'm sorry. We want our debt to be between 40 and 60%, which means you want your equity to be between 60 and 40%, right? Why do we have a range? We have a range because we don't know exactly where that point is. And what research has shown is that this curve is not as curvilinear as this looks. Again, I'm going to try to graph it. It's very shallow. It's a very shallow curve. So if you're not exactly at this point, there's a substantial difference in value here. But in this case, in reality, if you're a little to the left or right, there's not a critical change in value of the firm. So we're going to continue now talking about how this affects decision making in the corporation. See you in the next video.